Today we take a left at the fork in the investing road to talk about private alternatives. What are they, you ask? Could be anything from private equity to hedge funds, even art. The next question is, should you be thinking about adding these instruments to your portfolio? Well, we're going to get into that right now and more right here on UBS Trending. Hi, everybody, and welcome to UBS Trending. I'm Anthony Pastore. Thanks for being with us today. My guest in the studio is Eric Adler, CEO and President of PGIM Private Alternatives. Eric, great to have you here in the studio.
Oh, it's great to be here, Anthony. Thanks for having me.
You know, private alternatives in general, private equity, private credit, it's coming up more and more and more in the conversations around investing. And it's nothing new, but it's something that has really lifted a lot of interest here in our CIO. We say that every portfolio, or at least many, should have at least some allocation to privates. So before we go into more of the conversation, just give us your best description of what private alternatives are and how they fit into an investment portfolio.
Yeah, so private alternatives, really it's not as different as one might think from the public markets, the public bond and stock markets. The difference is they're not freely traded, and that makes all the difference in the world, actually, because it means that overall, the assets aren't as easy to get a hold of, so there's a lot more operational know-how that needs to go into acquiring these assets than managing these assets. And they can be across the spectrum. Private equity, it's buying companies. They could be public or they could be private. Real estate is more asset-backed type transactions. And debt is like the typical loans you'd expect. They can be loans to companies or different kinds of asset classes. And the real distinction is because they're not freely traded, there's an illiquidity premium that you expect. And that's really where it fits into a portfolio. The illiquidity premium obviously gives you a bit more return in exchange for a bit of illiquidity risk you need to manage. So you know that's the big difference. And also there's a lack of correlation with the public markets. They often move in a way that's different from what you're used to seeing from the public bond and stock markets, so you get a good diversification through them. And I think that's what investors are increasingly attracted to. And at first they wanted just a little bit because of the concern for illiquidity, but as they've gotten comfortable with it and how to manage it through a portfolio allocation model, they realize they can take more and more of it on and still work the liquidity out through their public areas. And the fact that if you diversify within private assets and private alternatives, they also don't work in lockstep either. So you actually have the ability to liquefy some of them at times when others are more illiquid. So little by little, the market's getting very used to them as an essential part of a portfolio.
Right, and I think for an investor who's working with a financial advisor, which all of our clients at UBS are, you know, it's becoming part of a conversation when they have a sort of a financial goal analysis conversation, looking at their portfolio with their FA. Privates are likely coming up in those conversations because they're becoming, I wouldn't say commonplace, but certainly they're a more common topic to be discussing rather than the traditional 60-40 portfolio of 60% equities, 40% fixed income. So now you've got alts in there as part of that 60-40 allocation. Whether you throw that out the window or not, it's still a part of the conversation. So when you look, PGIM is one of the largest alternative managers in the world. And so from your perspective and where you sit, Eric, what's the current landscape for alternatives today? And where do you sort of see it more long-term if we're thinking down the road like 5 to 10 years?
Yeah, so if you look across the asset management environment, it's the area that's been most dynamic for the last 5 or 6 years. The granddaddy of them all, if you will, is private equity. That's been around for a good 50 years. And that's still the largest of the private alternative asset classes, but it's more stable, more mature. It's been growing, but a lot of the growth in private equity has actually been through recycling of distributions from old deals. And because the business has been so profitable since the GFC, the growth has been from reinvesting the profit. But the importance of what I just said is that it's recycling distributions. And with interest rates where they've been, inflation where it's been, it's created a bit of a bid-ask spread in pricing as the increased interest rates have meant that buyers expect a price discount, but there's no distress in the system. So the sellers are still holding out for their old valuations. And that's led to a bit of a freezing in the markets. And so the private equity space has great days ahead of it, but it's been a bit quiet recently. And that's opened up the door to other asset classes. Real estate's another old strategy that's been around a long time, very cyclical. And again, with the interest rates where it's at, it's been a little bit in a downturn right now, but that'll naturally rebound. So you'd expect real estate to pick up again. The two really big changes are in infrastructure and in private credit. And the private credit space is really a factor of several dynamics. The biggest one was increased regulation to the banks after the GFC. So they've pulled out of some of their traditional lending spaces. And more recently, the bond markets have been a bit more chaotic. And that's just left a big opportunity open for the private credit players. And many of the traditional private equity players have seen that and have moved into that space, and we've been no exception. So private credit's becoming quickly probably the fastest incremental growth in the space. And finally, I'll mention infrastructure, which maybe if you look 5, 10, 15 years down the road, that may be the biggest structural opportunity. If you think about all of the big thematic challenges that we have globally, and that's governments, that's regional, that's public and private markets. You think about decarbonization, that's transitional and renewable energy. You think about demographics, that's healthcare, that's senior housing. You think about digitization, that's increased need for data, cloud computing, and all of the hardware that goes into that. And urban modernization, huge challenge. So that's smart cities, all of the infrastructure and communication channels that have to be modernized within cities and between cities, transport as well. All of that is infrastructure. So that's just going to continue to boom, and technology is affecting all of those sectors. So
that's kind of the long-term look. In the more short-term capacity, when you're thinking about where the Federal Reserve might go, and at this point we expect maybe 1, maybe 2 cuts this year, maybe 2 or 3 next year, certainly less than we thought at the beginning of the year when it was going to be 5 or 6 of them. How much of that impacts your day-to-day when you're looking at the opportunities within the private alt space, especially on the debt side?
Yeah, more and more, because the fact that interest rates are staying higher for longer.
And with a currently inverted yield curve that's been inverted for almost 2 years.
Yeah, absolutely. So what that does, it means that this price discovery that we need across almost all of the private asset class is just taking longer to get there. Because the hope recently was that if interest rates were to come down more quickly, a lot of buyers' expectations in terms of discounts would go away, and you could find price discovery between buyers and sellers more quickly. But as those interest rates stay higher for longer, you still have a big gap between the two. And so that's slowing down transactions generally. The exception, as you say, is private credit. That's still very active. Now, what's interesting, a lot of the new private credit opportunity is going into insurance balance sheets. It's insurance, which is seeing that actually private credit is a great asset to put next to longer-term insurance liabilities. Right. So that's, even with these interest rates at a high level, you're seeing a lot of private credit opportunity because of that.
And on the real estate side, you mentioned real estate before, because we talked about infrastructure a little bit. So private real estate, what market are we talking about in there when you're talking about private real estate within the alt universe?
So there's a lot of asset classes. The basic ones are all the living sectors, so multifamily of all types. That can be student housing, senior housing, but also a lot of industrial or logistics, which has just benefited from the online shopping massively. And it's actually also benefiting from deglobalization. It's creating new areas and new types of industrial and logistics space you'd need. Office, which has been challenged. But in real estate, you're always looking to be counter-cyclical. So I think office is being oversold. It's a challenging space. There's no question about it. But there's a fear around it that probably makes for good entry points for investors with a longer-term view. And of course, retail, which has really been challenged because of this online shopping. And that's been a bit Darwinian. It's been a bit of a survival of the fittest because it's been 10 tough years. And then with COVID shutting down any kind of anything that wasn't remote, the remaining concepts that have stood the test of time, some of the outdoor concepts, some of the needs-based concepts, are actually some of the best investing opportunities you can see. And so that's US, but again, we could go around the world. There's specific opportunities in real estate depending on what you're looking to do and what region of the world you want to play
Yeah,
in.
I mean, I just hearing from you right now, I mean, this is a massive universe of investment opportunities or possibilities, and everybody should be connecting with their advisor to figure out what's right and appropriate for their own portfolios. But thanks for taking us through, Eric. I think, yeah, this is only scratching the surface here. We barely got into the idea of secondary offerings, which exists in private alts. So we'll have to have you back to talk more about that. But thanks for coming by, and thanks for sharing with us all the information, because obviously this is a topic that's important to discuss, especially these days where the markets are moving. So good to see Eric.
Thank you. It's
Great
great to be here.
Great. Eric Adler from PGIM Private Alternatives. And by the way, if you want any more information from UBS or our great partners like PGIM, make sure you're checking out our Insights website at ubs.com/views. Plus, you can follow us on social media. We're on all the major channels. Plus, you can also follow us at Instagram. Our channel there is at UBS Trending. So make sure you give us a follow there and take a look at that content that's up on our account. And as always, if you have any questions, as we recommend, make sure you're talking to your financial advisor. Until next time, I'm Anthony Pastore. Have a great rest of your day, and remember to keep your eyes on what's trending. We'll see you soon.